Interest rates play a crucial role in both personal finance and the broader economy, affecting how people borrow, save, and spend money. Interest is added to loans, meaning when individuals or businesses borrow money, they must pay back the amount they borrowed plus an additional percentage, which is the interest. For example, if someone takes out a loan to buy a car or a business secures a loan to expand its operations, they will repay the original amount of the loan plus an interest charge over time. The rate of interest determines how much extra they must pay. A higher interest rate means borrowing becomes more expensive, while a lower interest rate makes loans cheaper. On the other hand, interest is also added to savings. When people save money in a bank, the bank pays them interest as a reward for depositing their funds. The interest earned on savings depends on the interest rate offered by the bank. A higher interest rate means savers will earn more money over time on their deposits. Low interest rates generally lead to increased spending, as borrowing becomes more affordable for both individuals and businesses. When interest rates are low, people are more likely to take out loans to buy homes, cars, or other large purchases because the cost of borrowing is reduced. For example, if the interest rate on a mortgage is low, more people may be able to afford to buy a house, as their monthly payments will be smaller. Similarly, businesses may take advantage of low interest rates to invest in new equipment, expand their operations, or hire more employees. The reduced cost of borrowing encourages businesses to grow, which can stimulate the economy. Consumers, too, tend to spend more when interest rates are low because saving becomes less attractive. With savings accounts offering little return, people may choose to spend their money instead of letting it sit in the bank. This increased spending can boost demand for goods and services, helping businesses grow and creating a positive feedback loop in the economy. Conversely, high interest rates tend to lead to decreased spending. When interest rates rise, borrowing becomes more expensive, which can discourage people and businesses from taking out loans. For example, if interest rates on mortgages increase, fewer people may be able to afford to buy a home, as the cost of monthly mortgage payments would be higher. Similarly, businesses may hold off on expanding or investing in new projects when interest rates are high because the cost of financing these ventures becomes prohibitive. High interest rates also encourage people to save more, as the return on savings increases. With higher interest rates, consumers may choose to delay big purchases and instead put their money into savings accounts or other investments that offer a higher return. As a result, consumer spending slows down, which can reduce demand for products and services, ultimately impacting businesses' sales and profitability. In periods of high interest rates, industries that rely heavily on borrowing, such as construction and real estate, tend to suffer the most. For instance, when interest rates are high, potential homebuyers may be priced out of the market due to the higher cost of mortgages. This, in turn, affects construction companies, which may see fewer housing projects because of reduced demand. Retailers and manufacturers may also experience a downturn as consumers become more cautious about spending. On the other hand, high interest rates can benefit savers, especially those with significant amounts of money in savings accounts or fixed income investments. These individuals will earn more from the interest on their deposits, which can provide them with greater financial security. In summary, interest rates directly influence borrowing, saving, and spending behaviors in the economy. Low interest rates make borrowing cheaper and encourage spending and investment, which can stimulate economic growth. High interest rates, on the other hand, make borrowing more expensive and encourage saving, leading to reduced consumer spending and a slowdown in economic activity. The balance of these factors can significantly shape the financial decisions of individuals and businesses, as well as the overall health of the economy.